Well, good afternoon. This is Elliot Kallen. I'm the president of Prosperity Financial Group, and I want to welcome you to another episode of Meet the Expert. We've been doing this now since the lockdown in March. Very exciting, the series that we brought out. We're getting tremendous accolades from them. We're going to do this through the beginning of July. Then we're going to take a little bit of summer break, just like TV does, and we're going to do interviews, one-on-one interviews, and bring those to you on our website and send you links to those. That'll be pre-recorded with a series of questions. So this is exciting. We've got two outstanding speakers on topics that we keep being asked for. Kirkpatrick is going to be our first speaker. He is going to be talking about the difference between Main Street and Wall Street, particularly when it comes to real estate, because his background is the global real estate investment market. We'll talk a little bit about that as we go. Then we've got two more speakers from BlackRock. They're going to be talking about Social Security. It's a topic that I could probably have up every single month for the rest of the year, and there will still be questions about it. So we'll do that. Next week's topics are going to be continuing on the real estate mode. We're going to have a mortgage expert on talking about the rates and how to refinance your property into the lowest possible number, whether it be in years, in dollars, or whatever needs to be done. And we're going to talk a little bit about financial management and behavioral finance and where those two intersect, which means how do we make financial decisions and why do so many people make the wrong decision always at the wrong time? So we'll talk about that, including, unfortunately, I have some clients that went to cash at the low end of the market and they're still in cash today, unfortunately. So hopefully they'll be able to buy back in the future. This has been another tremendous upswing in the markets for the week. Again, I've been talking every time about whether we're on a V or a W or an L or a U. So let me just tell you again, a V is when markets go down quickly and they come up quickly. Now bonds still have not come back. They're still down up to, some of them are down still 14%. Some of them are down just 2 or 3, but they've not, outside of the US Treasuries, they've not come back. So that's a V. I believe we're gonna have a W, which means it's gonna come down, not to where it was in March, not to Dow at 18,000, but we're going to come down. We're going to see some softening. It's gone up very fast, and then it comes down, and then it shoots back up. I believe the fourth quarter will be a great fourth quarter with profits and so forth. Putting politics aside and who the next president is, I think we should have a pretty good fourth quarter in there. And we are preparing our portfolios for the fourth quarter. So if you've seen a lot of activities on your portfolios, then you'll know what we're doing. If you're looking at this for the first time and you have not had a conversation with your advisor or with us about how to reposition your portfolio to take advantage of the fourth quarter, give us a call, 925-314-8500. You can also email me at Elliot, ELLIOT, at Prosperity, F like Frank, G like George, prosperityfg.com, or our website is www.prosperityfg.com. We've got myself, we've got Emmett, we've got Jamie, we've got a lot of terrific advisors, all-star type of people that can help you out depending on what your needs are. So let's get started with our first speaker. Kirkpatrick is a founder of a company here in Orinda, a local real estate investment trust company at here, Orinda Management. He is a specialist in the real estate investment market. So Wall Street's been going up, and there are great concerns that Main Street and real estate is going to go down. And I'm going to ask him a few questions. We'll do this in an interview format, but I want you to know you can email me your questions and I will do my best to ask them. Same thing on Social Security. I'll interrupt the speakers or ask the speakers at the end. So Craig, welcome.
Yeah, welcome. And thank you for having me here at your forum today. I've been in financial services for the last 30 years. I work with financial advisors all over the country, and very few of them are putting forum together like you guys have been. So touche to you for this educational platform.
Great. Thank you, Craig. So let me ask you a question, because we're going to talk maybe in the end, one of the questions is how does this affect my personal residence? Since that's what so many people are interested in. But let's talk about what is a real estate investment trust?
Right.
How do people invest in it? Why do people invest in it? And how does that, why just not go out and buy something direct and forget being a shareholder in a real estate investment trust?
Yeah, when we talk to investors all throughout the country and you mention the word real estate, most people think of their homes. And what we're talking about is commercial real estate. Think of the apartment buildings, office buildings, shopping centers all throughout the United States. And if you were to go add all that up in the whole US, there's about $27 trillion of US real estate on Main Street, right? Think of Barcadero Center or Broadway Plaza in Walnut Creek. But there's also traded companies that trade on Wall Street. There's about 200 of them today. They're called REITs, Real Estate Investment Trusts, and they are required by law to pay out 90% of their taxable income. So investors like those for income. Although what's been happening lately with COVID and all the changes, there's been a lot of uncertainty and a lot of discrepancy on Wall Street as these stocks are trading up and down in value.
Okay. So along those same lines of real estate investment trust and commercial property, I know that there's a large percentage of restaurants that will not survive what's going on. We all know that we go by these strip malls and these mini malls, maybe not the large malls. They're just going to hurt. They're in pain. I know when you go by the mall in Walnut Creek and Concord up there, or Concord, there's a lot of pain. And if Penny's and Sears and Macy's close, that's the end of that mall completely at this point. So that's happening all around the country. So why would I want to invest in what doesn't appear to be a good situation?
Yeah, I think the biggest difference, again, for me, it's 30 years of investing in all different real estate companies. And even through the financial crisis, real estate wasn't impacted this way. One of the big takeaways today is that there's real estate sectors, and they're all going to perform differently, different risks, different opportunities. So you mentioned retail, which is a sector that's going to be challenged. It was challenged before this with Amazon and so forth. For those of you in Walnut Creek, Broadway Plaza, think of Broadway Plaza, that's owned by a publicly traded company. This last month, only 25% of the folks that are renting for Broadway Plaza paid their rent. So I think there are certain sectors that are going to do really well. Retail is going to be one that's challenged. There's probably 1,500 malls in the United States today, and about half of them are going to get bulldozed or repurposed. So I think as an investor, working with a professional and finding out which sectors will do well. Hotels will be challenged in this environment, but there are areas that can do okay in this market.
So I'm just reading today about Hilton. They're going to eliminate 2,300 employees from the company. And if they're doing it, so will Marriott and everybody else. And I know these are inside many real estate trusts.
Yep.
But the medical industry, the senior citizen, the critical care places never seem to have a recession. Right. So isn't that the best place to put my money if I want to be in real estate?
Yeah, long-term medical facilities is a great place to invest today. Another area that's really interesting are data storage centers. They're actually up year to date. Another good sector is industrial properties, which have been thriving through this marketplace. So it really, and by the way, let's just say that there's no national market for real estate, right? It's all local, whatever's happening in that local market. But in general, certain property types will do better. Senior medical facilities, absolutely during this time, especially because interest rates are so low and investors need income. But I do think it's an interesting time, and navigating the sectors are going to be really important.
Okay, so in investing, we know sometimes the greatest contrarians, like Warren Buffett, win long term. They just do a great job. They're able to invest because they have the cash flow where no one else would ever dare take a chance. Yep. To buy railroads when railroads are worthless, to buy oil when oil is super low, and so forth. So I'm going to assume in the real estate market that it has all the same cycles as every other industry. And that means that are what we call disparities in the industry, which means something is very up and something is very down. And if I want to be contrarian, but invest for the next 10 years or 5 years, what does that mean as a real estate investor? And how would I take advantage of this recession, retail recession, but maybe an economic boom in another way?
Yeah, so it's sort of interesting. We're talking about Main Street versus Wall Street. I'll give you an example. There's a New York office company called SL Green. It's traded on the New York Stock Exchange, owns really nice office buildings in New York. In January, it's trading at $100 per share, and just a month ago is trading at $40 a share. So Wall Street is saying office buildings in New York have dropped 60%. Is that right? Is that too much? Does it need to drop more? This is what all of us analysts on Wall Street are trying to figure out. But I do think even though the office market's going to change because many people will be working from home and there's still some uncertainty, I think the office sector long-term might be an interesting place to invest. So this is an interesting industry because you have Main Street. You and I could get together and go buy an office building in New York, but you can also buy a traded company. Sometimes these traded companies get really cheap. I think a company like SL Green is probably trading below the value of its real estate. But it's a volatile market as this uncertainty continues, right? We as humans don't like uncertainty. There's a lot of that today. But being contrarian in an area like office, for example, might be interesting because I do think ultimately here this will subside. We will go back to work and we will be going to office buildings. When and how, that's the uncertainty that exists.
Okay, so we're living in a world that has, in the last few weeks, seen an upheaval of protest, but unfortunately an upheaval of rioting. Mm-hmm. And there's a lot of commercial space that has been destroyed. Yep. I just watched a video this morning of the Mercedes-Benz dealership on Broadway in Oakland. That cars were just burnt up and destroyed. Never made the news, but it's awful what happened there. So since this is affecting commercial real estate, how does this affect the real estate investment trust market?
Yeah, well, it depends on whether that real estate investment trust owns properties in those locations and whether they have insurance or not. And that really just gets down into doing the analysis of where the properties are. And yeah, commercial real estate in particular, both with COVID and the protests, have been uniquely impacted by this, by this current situation. But understand, if you invest in a traded REIT today that trades on Wall Street, you might have 1,000 properties in different states, different cities, different locations. So you really are diversifying your risk from just, again, if you and I went together and bought a building in Oakland, we'd have really geographic risk. So one of the things the REITs have done to ease the ride out is be very diversified. So that's one way to try to protect yourself from this kind of thing.
And what's the difference between a public REIT and a private REIT? Yeah,
a public REIT. By the way, IBM's a computer company, GM is a car company, and REITs are just real estate companies that trade on the New York Stock Exchange. So they have ticker symbols and they go up and down. That's a public REIT. Private REITs are not public yet, and they're building a portfolio of real estate, hopefully to go public someday and take advantage of that private to public marketplace. Both in general are owning real estate. One might be a little more liquid than the other. And that's kind of the main difference.
And then what's your feel for someone that would rather be partners in a building versus buying a REIT and vice versa?
Yeah, I think, well, the big headline here, right, is that interest rates around the globe are really low. People are going to need income and retirement income. So I do think real estate long-term, that fundamental has not really changed. But I do think if you're going to venture out and buy an individual building today, you really need to think about your return requirement and all the associated risks. I think long-term it will be, well, again, it's all location, 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 and who your tenants are. I think hotels and retail in particular are going to be challenged for a long time. If you're a Warren Buffett and opportunistic, maybe you would go and be contrarian there. But there's just no price discovery, Elliot. So if you have an office building in Oakland today that you want to sell, you probably want to sell at a price 3 months ago. If you're a buyer, you're like, I'm going to wait. I think this property value is going to go down. So it's really hard today on Main Street to see what prices are. So there's no price discovery, there's uncertainty, and that's why we're seeing all this volatility.
Just a couple more questions, Craig. And that is, are we in for a major commercial real estate correction?
I think by sector, generally, by the way, real quick, headline, the biggest risk to real estate isn't a recession, it's just if we build more. If you put an office building across the street from where you are, that's going to do more to affect rents. That's been the 20, 30-year risk of real estate. I think we are, from a commercial real estate standpoint, I think it's by sectors. I think hotel and retail will be challenged for a while. I think office will be under the gun. Industrial properties, medical buildings, industrial buildings will do well. So I guess my conclusion or my headline on this talk is that Usually all real estate kind of goes up and down together. This is going to be by individual sector. So it's no longer the case where you can just buy a bunch of REITs and hope it goes up. You've got to really be targeted with what the property type is that you own. But there's some great yields out there. I mean, 6, 7, 8, 9% cash flow dividends in this environment is good, but it's volatile.
Well, we could make 6, 7, 8%. Okay. Last question. Is there going to be a spillover to my own personal property if there is a commercial real estate?
Yeah, great question. The whole real estate housing market's been in flux. Government came out and said you don't have to pay your mortgage if you don't want to. It really depends to me on whether this whole COVID crisis turns into a long-term credit issue with the home buyers. Remember, rates are really low, and that's going to keep housing prices up. So I think the answer to that, time will tell over the next, 12 to 18 months, what happens with housing prices. The government is for sure, putting $3 trillion into the economy that should help stabilize that, but it's unknown.
So if I have a client that wants to buy a new home or trade up to a new home or get a second home in Dallas or Florida or Tahoe, should I tell them to wait a year?
Yeah, again, it's by location and what your time frame is. If you want to own that, what are the reasons for your owning the home from an investment property standpoint, and that's it, or you just want to be there and hold it for the next 5 or 10 years. I think with rates being so low, you can get really attractive mortgages. Locking that in is probably not a bad thing. But again, it's location and the area you're buying in. Some areas will do well, some will be challenged. I know that's kind of a wimpy answer, but I think given the uncertainty with different pockets and different economies in different states, it is hard to know.
Well, great. We've been talking with Craig Kirkpatrick. I want to thank you very much. Learn a little bit about the real estate investment market, and we're going to continue with this. So Craig, thank you.
Yeah, thank you, everybody. Thanks.
Okay, so let's go to our second set of speakers right now. That's great. Let me just tell you again, you're listening to Meet the Expert, Prosperity Financial Group. Thank you for being here. You can see my desk behind me. If you're good with trying to analyze somebody, you'll see 1,000 pictures of the family, a couple of awards, and a whole bunch of sports stuff. I've got my New York Jets stuff. I always laugh. I've got my Ranger mask right here, and a true New Yorker, and I've got my New York Jets mask right here. So make sure you got to be true to if you're out here and you're a Raider or you're a Niner fan or a Giant fan, I hope you have your orange or silver or black and so forth. So, and over my left shoulder, you'll see the Prosperity bottle of Prosperity wine. And then I've got the Prosperity coffee cup. I feel like I need Prosperity popcorn and a Prosperity bottle of water to make it complete here. So let's continue with what we're doing. Our friends from BlackRock, that's BlackRock is down the street from us. Our friends from BlackRock are here, and they're going to talk about Social Security. So BlackRock, one of the largest investment companies in the world. If you've not followed them, they're a public company. You can follow them. They're a monster. $1 trillion plus as a company. That's just, I got to think about how many zeros that is, but I believe that's 12 zeros, if I'm correct. And then Samantha is, you've heard me introduce the people that call on us. We call them reps or we call them vendors, but they're our strategic partners in the business. So I want to introduce Samantha Yaloff, who's going to come on, who's going to introduce our speaker, Jennifer, who's from New Jersey. We won't hold that against her, but she's from the Jersey Shore. So that's not so bad. And so Samantha, come on and introduce yourself and then introduce Jennifer, please.
Of course, of course. So my name is Samantha Yaloff, as Elliot mentioned. I'm based in San Francisco. I've been at BlackRock for the last 10 years. I've worked there. And as Elliot mentioned, BlackRock is the world's largest asset manager. And we're lucky enough to get to partner with the best RIA firms in Northern California. So firms like Prosperity, and you get great partners there at the firm, and fortunate enough for you to get to work with Elliot. So and we're happy to provide some of the tools, resources, insights that we have at the firm and share them with Elliot and share them with you. So we decided to spotlight today BlackRock's Social Security program, and we've got one of the best experts at BlackRock here on the line. So I want to introduce my colleague, Jennifer Taboada. Jennifer has been in the financial services industry for the last 15 years. She's been with BlackRock since 2008. So she has deep expertise in creating, implementing, and presenting these educational programs on financial planning topics to advisors and clients across the country. So currently, she leads our Social Security consulting team at BlackRock, and she serves as our national specialist on the topic of Social Security. So today, Jennifer will go over the nuts and bolts of BlackRock's Social Security program, and we'll leave plenty of time to ask questions as it pertains to you or as it pertains to the subject matter. So I'm really excited to turn the call over to Jennifer to dive into our Social Security program and how it affects you as clients.
Excellent. Thank you, Sam, and thank you for that introduction. Hopefully everybody can hear me and see the screen okay? Awesome. All right. So I'm sure you all are very excited to spend about the next 40 minutes with me on Social Security. I assure you this topic, although you might think may be a little bit dry, I promise it is the most requested presentation that we give at BlackRock. And the number one reason is, let's be honest, what do we really know about Social Security? Right? Social Security is not walking around handing out pamphlets saying, hey, this is how you can get more out of our system. If anything, they're trying to do quite the opposite. They want you to sign up for benefits immediately. And that's not my goal today. My goal today is to simply go over some of the basics about Social Security, how to take your benefits as an individual, how to take them as a couple, and more importantly, go over some strategies that you can employ in order to maximize your benefits. So let me preface, there is no wrong and or right way to collect Social Security, right? I'm not here to give you the magic answer today, but there are ways to maximize your benefits that you can get more out of the system that frankly you've been paying into your entire life that you know very little about. Right. So with that being said, believe it or not, Social Security was first initiated in the 1930s as a supplemental income to the elderly. At that time, the life expectancy was a whopping 58 years old. Now, the age at which Social Security allowed you to take 100% of your benefit was actually 65. So think about it. Your life expectancy was 58, but hey, if you can manage to make it to 65, we'll pay you 100%. Right? Clearly, that's not the times we're living in today. Right now, you know, a couple that's reached the age of 65, one of you has a 50% chance of living until the age of 93. One of you has a 25% chance of living until the age of 98. So now you're looking at 20, 30 plus years into retirement that you need to make the best decision possible, right? And how you file for benefits can not only affect what you will receive for the rest of your life, but possibly what your spouse will receive for the rest of theirs. So you want to make sure you're making the best decision because unfortunately, over half of those currently collecting Social Security benefits are collecting them at a permanently reduced rate, right? You're probably thinking, why is that? Well, to be honest, number one reason is because you can, right? You've been paying into this your entire lives. You want to start reaping some of those benefits. So you file as early as 62. But remember, if we are going to file for benefits as early as 62, you want to make sure they're for the right reasons. There's no wrong and or right way. But let's talk about how you even qualify to receive Social Security benefits in the first place, because you do have to qualify on your own record to receive them. You have to have earned at least 40 credits throughout your lifetime. You can earn up to 4 credits per year. So that's a minimum of 10 years that you have to pay into the system in order to be eligible to receive benefits on your own record. Now, how they come up though with those benefits that you see on your Social Security statement at 62 for retirement age and age 70 is that they're looking at the best 35 years of your work history. So not the entire work history, but the best 35. Right? So how do you use this to your benefit? Well, you worked more than 35 for every single year that you could replace one of those smaller numbers with the higher one. Come next year, Social Security will automatically increase your benefit check. Let's say you only worked 10 years, you just qualified, but you have 25 years of zeros. Well, for every year you could replace one of those zeros with a number. Come next year, Social Security will automatically increase your benefit check. This is an ongoing calculation that happens every year up until the day that you actually file. Right? So as long as you continue to pay into Social Security, this will automatically, make changes to your benefit amounts. Now, the biggest tip though that I can give to you is that when you're looking at your Social Security statement, right? Sometimes we forget to realize that on the left-hand corner of that statement, it says your estimated benefits. That's because that's exactly what they are. They're completely estimated and they change every single day up until the day that you file for benefits. Right? So they always assume that you're earning your current income level up until the day that you file. So for example, if you're earning $100,000 this year, they're assuming you're earning $100,000 up until the day that you file for benefits. So if your income decreases or you have your income changes drastically in some way, shape, or form, then that benefit could be very different than what had originally been anticipated. So try not to focus so much on the actual number because that will change, but focus more on the strategies you can employ in order to maximize your benefits. Now, of course, you're probably sitting there going, well, I want to know what my benefit is. Of course you do, right? That's how much you're going to receive on a monthly basis. So that's important. And we do want to make sure we get you an estimate as close to what you're really going to receive. Now, this is something that Social Security can't do for you, but this is something that your financial advisors here at Prosperity Financial can do for you. So reach out to somebody on the team, and they can run you the analysis based on your particular changes, meaning if your income is going to change or you are going to retire early, they can run that number based on those circumstances and get you something that you're more likely to see once it is that you are ready to retire. So just make sure that you're having that conversation. Now, if you're probably thinking, well, I haven't received a Social Security statement in forever, it's probably because you haven't, right? They stopped sending it out to anybody under the age of 60. So if you're over 60, you likely receive it in the mail a few months before your birth date. If you've registered online, you'll never receive it in the mail, right? But previous to that, anybody who wants access to that statement, you're going to need to access it online. Now, I do urge everyone to access their statement on an annual basis, no matter what. And the reason being is that Social Security openly admits on messing up on 7 to 8% of these. They say, hey, we're the government. And guess what? We make mistakes. And if we make a mistake, unfortunately, that error, guess what? Is yours, right? Because you should have realized there was a mistake on your estimate and your statement, and you should have let them know when that was. So they give you actually a statute of limitations as to how long you have to report that error. It's 3 years, 3 months, and 15 days. Don't ask me how they come up with this number, right? You'll notice throughout the presentation, they like to make things extremely complicated for literally no reason. But once you're outside of that statute of limitation, that error is yours. So again, you want to make sure that you're checking on an annual basis. The best way, again, is to go online. The site is www.ssa.gov. The way that I remember is always, if you think of SSA backwards, think of the government, right? Now you won't forget. Just make sure not to type it in incorrectly, right? That's bad news bears. But once you go onto the site, right, you're going to have access to your Social Security statement, and you're going to be able to print it out and set it up for your appointment so that you can have an analysis run on your particular situation. So at the very minimum today, if anything, go on, register. It only takes you a few seconds, and make sure that you have access to that statement and that it is correct. Now, once you're eligible for Social Security benefits, when is the earliest that you can actually receive them? You can receive them as early as age 62, but they're going to be at a permanently reduced rate for the rest of your life. Once you reach your full retirement age, that's the age Social Security wants you to be retired. That's the age at which you're going to be eligible for 100% of your benefit without any type of penalty. That's also called your primary insurance amount. After your full retirement age, you basically earn delayed retirement credits for every single month and year you do not collect past your full retirement age. So you can earn up to 32% increase, and we'll talk about that exactly in the next few minutes. Now, if you're wondering what is your full retirement age, that's a great question because it has changed throughout time. So most of you will typically be in between the 1943 and 1954, that your full retirement age in that case would be 66. Those of you who were born in 1960 or later, it's 67. And you're thinking, wait, she's forgetting about me. I didn't forget about you, right? If you're in between the 1954 and 1960 mark, Social Security likes to make things complicated, remember? They actually add 2 months to every year above 1954 to your full retirement age. So if you're born 1956, your full retirement age is actually 66 and 4 months, right? So this is not something you need to remember the calculation or the math, right? It's going to be listed on your Social Security statement. The only reason I bring it up is because if you want to be retired at your full retirement age, right? So your full retirement is 66 and 4 months, but you retired at 66, then you retired early, right? So you might not have as many choices should you've waited those additional 4 months. So just make sure you know exactly what that time frame is. Now, if you do take your benefit early, remember, it is at a permanently reduced rate up to a 30% discount at age 62, depending on your full retirement age. And for every single month and year you get closer to your full retirement age, the more of that benefit you're going to be eligible to receive. So it does increase on a month and year basis, but the common misconception is always like, well, doesn't my benefit grow until full retirement age? Does it grow? No. You just get more of what was owed to you as you get closer to your full retirement age. So just understand this goes on a month and year basis. Now, some of the questions that you're going to need to be prepared to answer when you sit down with your financial advisor here at Prosperity Financial, when you're ready to run that analysis, is whether you're married. Are you divorced? Is there a big age difference between you and your spouse? how long do you plan on living? Right? So when they ask you that and you look at them like a deer in headlights, the truth is that is a very important question, because longevity does play a huge part as to how we're going to help you determine when to file for benefits. So of course, we don't know how long we're going to live, but we can make a pretty good suggestion based on your current family history, your current health situation. Typically, and right now, statistically, a male will live around 85, women will live to around 90. I'm Cuban American. I was the first one born in this country. I don't know if it's all the rice and beans we eat, but we live well into our hundreds, right? Go figure. Lack of healthcare, 100 plus, right? So I'm going to put in 100 plus for myself, but you guys can change it to obviously whatever it is for your situation, or as many different life expectancies as you want us to run the analysis with. Another question you're going to need to be prepared to answer is whether you're going to continue working, right? Because again, Social Security benefits are for those who are retired. So if you decide to continue working and collect Social Security benefits at the same time, and you're previous to that magic number, that full retirement age, Social Security is going to subject you to the earnings test, which is really a fancy way of saying, well, we're going to penalize you because you shouldn't be collecting and working at the same time. So they give you an annual limit as to how much you can earn before your benefits actually start to be withheld from your check. So the annual limit in 2020 is $18,240. So for every $2 you earn above that limit, Social Security is going to withhold $1 of your benefit check. In the year that you turn your full retirement age, because remember, they like to make things complicated. So let's say you turn 66 in June. From January until May, you can actually earn a little bit more. You can earn up to $48,600. And for every $3 you earn above that limit, they're going to withhold $1 of your benefit check. Good news is once you've reached your full retirement age, they don't care. You can work until you die. You can make billions and trillions of dollars and it doesn't matter, right? Earnings no longer matters once you've reached that magic number, that full retirement age. Right? But previous to that, you have limitations, and you do have a limit as to how much you can earn, and it's not on a pro rata basis, meaning they're not taking a little bit out of every check up until they've withheld what they should have for the year. They're going to withhold everything until they've withheld what they should have, and then you'll start receiving benefits, if any at all. So just something to keep in mind if you do want to file for benefits and continue working. This is definitely a conversation that you need to have with your financial advisor and your CPA, right? Because they're going to help you determine what's going to count towards the earnings test, and then help you determine whether you should be filing or not. Typically, what's going to count towards the earnings test is anything that's listed as earned income on your W-2 or your Schedule SC if you're self-employed. So that's a good rule of thumb. But if you all remember those old school telephone books you used to get on your front porch that were like this big, right? That's kind of like how big the loopholes are as to what counts and what doesn't count towards the earnings test, right? So again, and you want to make sure you have that conversation so we can determine if what your earnings have any of those loopholes and whether they will count or not. Again, earned income, typically things like rental income, IRA, with your RMDs, withdrawals, that's not going to count, but something some other things might. So again, you just want to make sure what that is before you go ahead and file for benefits. Now, if you are retired, you filed for Social Security benefits and you're hanging out at home and you realize that hanging out with your spouse all day long was the worst idea you've ever had. Now, a lot of us can probably relate to this more than ever, considering we're going through this pandemic and we're all at home with our families a lot more than typical. Normally, I could tell you I'm on the road 3 out of the 5 days, of the work days out of the week. I can assure you that I definitely like my family a lot more when I'm not here as much. But lucky for you in terms of Social Security, at least, you do have a choice and a way to change your mind. Right, so it is called a request for withdrawal of application. It's literally the form that you see before you. So you just fill out the form, right? You hand it in, and of course, nothing comes without a catch. Not only do you need to fill out that form and hand it in, but you need to have made the decision within the first 12 months of filing. So everyone has only 1 year from the date of filing to change your mind on whether you want to withdraw your application. You also have never done it before because it is a once-in-a-lifetime do-over. And the biggest catch of all is you do have to pay back everything you've received thus far. So that's a pretty big catch, right? Because it could be a pretty hefty check if you did wait and, let's say 11 months to change your mind. So my tip here is obviously you want to make that choice sooner rather than later if you do want to go ahead and change your mind. Now, we talked a lot about what happens when you take your benefit early. What happens when you take it later? Well, Well, you earn delayed retirement credits like I mentioned, and this goes on a month and year basis just like before, except now you earn 2/3 of 1% for every month you don't collect. You can actually earn 8% annually, up to a 32% increase at age 70. So again, it goes on a month and year basis. Just remember, if, since it is going on a yearly basis, if you have a full retirement age, for example, of 67, you're only 3 years away from 70. Therefore, you only have a maximum of 24 credits that you can earn. Right? So just keep that into account. You do lose out on that 8%, unfortunately. So just remember, it goes on a month and year basis, depending on your full retirement age. Now, if you are a single individual right now, meaning you're not married, you're not divorced, you're not widow or widowed, you're just single living your best life, then unfortunately, you're not going to like me very much right now because there really is no strategy as to how to file for Social Security benefits. You're just going to need to figure out when it is you're going to pass away, and we can help you determine when to file for benefits, right? Super easy. But we do run a break-even analysis for everyone to help you make that decision. And that break-even meaning, at some point when you file for benefits, you're going to earn the same amount from Social Security depending on when you pass away. So when will you earn more, right? When is that break-even? So in this situation, if the client didn't think they're going to live past 78, we would have said, hey, you should file probably at 62. If you think you're going to live past 82 and a half, maybe you should file at age 70. So again, it's just another tool to help you make that determination, and that comes with every one of your analysis. Now, I told you as an individual, no real strategy, but the good news is that being married does have some benefits. And the truth is that you only have to be married to your spouse for 1 year to be eligible for 50% of everything they've ever worked for. So you heard me correctly. You only have to put up with your spouse for a whopping 12 months to be eligible for benefits off of their records. Not a long time, right? So in this case, you have Jordan and Alex here. Jordan has a benefit of $2,200. Alex doesn't have a benefit on her own record, but Jordan is, Alex is eligible for half of Jordan's benefit, which is $1,100. And she's eligible for those $1,100 as long as Jordan is collecting. So that is literally the only rule, everyone, when it comes to filing for spousal benefits. If you want to file for spousal benefits, your spouse has to be collecting. That's it. If they're not collecting, you don't have access to that money. All right. And you have access to that full $1,100 as long as you file at your full retirement age. So it doesn't matter when Jordan files. Again, it matters when you do. As you notice here, Jordan did file early. He's collecting $1,650, but Alex still collecting the $1,100. Now, Alex does have the option to collect early as long as Jordan is collecting. But remember, just like any other Social Security benefit, it is at a permanent reduction. And it could be up to 35%. So I don't know if you recall, you could have a 30% reduction at age 62 on your own record. Spousal benefits are actually reduced at a higher amount, right? So 35% at 62. And for every single month and year you get closer to your full retirement age, the more of that benefit you're going to be eligible to receive. But what you notice now is that once you've reached your full retirement age, that benefit plateaus, right? Because spousal benefits and survivor benefits do not increase, meaning the only benefits that ever earn delayed retirement credits are your own. Anything based off of anyone else never increases. So if you are eligible for survivor benefits or spousal benefits off of your spouse and you're at least full retirement age, there's no rhyme or reason why you shouldn't be collecting. Because at that point, you're just leaving money to Uncle Sam. And what happens when you do that? You can wave it goodbye, right? So I'll give you a big tip here, everyone. When it comes to filing for Social Security benefits, Social Security will never, ever reach out to you, meaning you have to be very proactive about this and make sure that you're talking with your financial advisors here at Prosperity Financial, because Social Security will never say, hey, you forgot to file, or hey, you're missing out on benefits that you should have collected, right? If anything, they're just going to let you do whatever you want, right? Never collect at all. So you want to make sure that you do know what benefits that you're eligible for, right? And you're also, I always like to bring up, because of the fact that Social Security only reaches out to you via hard copy in the mail, just understand that this is like it's the federal government, it's like the IRS. The only time you're ever going to hear from them, if you do, it will be by mail, right? Certified mail in hard copy, as opposed to a phone call. So, right, they never call you. So if you ever get an call saying, hey, this is Social Security, it is a scam. Please hang up the phone. Do not give them your information. I only mention this because it is going around a lot. I've received the calls. So please don't ever, do that. Understand that it literally, they will only ever contact you by mail. All right, so now let's say your spouse waits until age 70 to collect. They're collecting $2,904. Right now, he's earned that delayed retirement credits. As you realize, again, Alex only eligible for those $1,100 because, again, spousal benefits do not increase. So this is the biggest mistake we see a lot of individuals make these days, especially when you have a higher and a lower earner. The higher earner will wait till the latest possible to allow the lower earner to receive the biggest half. That's not how it works, right? They're only ever eligible for that 50% of their full retirement age benefit. So you want to make sure, again, that if you are waiting till 70, it's not for that reason. Now, I believe most of you probably are aware that in a few years ago, they did make some changes to the Social Security laws. They did eliminate two very popular strategies. One's completely gone, so I'm not even going to talk about it. The other one was grandfathered in, which we are going to discuss. But the ability to suspend your benefit is something that most individuals are not aware of, that everyone here is eligible for, regardless of when you file for benefits. Meaning, even if you file for benefits early, everyone, once they've reached their full retirement age, can turn off their benefit, choose to delay, right, not collect anything, and up until the age of 70, and then collect their benefit again. And that way, you're now collecting up to a 32% increase on your already reduced amount. This doesn't require you to pay any money back. It doesn't make you have to fill out that form. You didn't need to make the decision within the first 12 months. You simply just need to be at least full retirement age. Call Social Security and say, hey, I don't want my benefit anymore. Please turn it off. They're going to go ahead and suspend it. And that way you can earn delayed retirement credits. This is a great way also to get immediate income. If you're in one of those situations now, the unfortunate circumstances during COVID, that maybe you're currently unemployed or you've lost your income, this is a good way to file for Social Security benefits, even if you're not ready to file right now, right? You can get immediate income. And once you've turned your full retirement age, you can turn it off and earn some of that reduction back, right? So this kind of allows you to do that without having to pay that lump sum back. Now, of course, there's always a catch, right? If you had somebody collecting off of your record, that benefit also gets turned off, because remember, number one rule, your spouse has to be collecting in order for you to receive that benefit. So if Jordan's benefit gets turned off, Alex's benefit also gets turned off. So if you want to do this, this is something that you're going to need to outweigh some of the benefits or not of whether you want to file, because you might have a spouse who's also not collecting for up to 4 years. All right, up until now, I talked about a couple where one has a benefit and the other one doesn't. What happens now if both of you have a benefit, right? What does Social Security pay you? So I know you're gonna look at the bottom of the screen now, you're gonna be like, oh my goodness, she's entered the matrix, forget it. She's really gonna lose me now if your head wasn't spinning already. But I'm gonna make this very simple for you, okay? Ignore everything at the bottom of the screen. Social Security is gonna pay you the highest of the two benefits you're eligible for. That's it. Okay, they never pay one plus the other. It's always one or the other. So if you're eligible for benefits on your own record or half of your spouse's, they're going to pay you the highest of the two. So Jordan here, Alex has a benefit here of $600, or she could receive half of Jordan's, which is $1,100. So which one is she going to get? The $1,100. That's it, right? The highest of the two. So just look at your benefit. Look at half of your spouses, whichever's higher is the one that you're going to receive. The only reason you see all that nonsense below is because your benefits do work in two pieces, right? Because remember, they like to make things complicated. So if you're eligible for $600, they just give you the additional $500 to equal what you should be receiving. Right? So again, don't focus so much on that. Focus more on just looking at your own, half of your spouses, so you can at least determine which one you're going to be eligible for. Because if you're one of those individuals who have a similar benefit to your spouse, then in that case, you're not going to be eligible for spousal benefits, right? Because each one of your own benefits is higher than half of your spouse's. So you're only ever going to be able to collect on your own record. Now, up until now, I told you you only have to be married to your spouse for 1 year to be eligible for benefits off of their record. Good news is you only have to be married to them for 9 months to receive 100% of whatever they were collecting when they pass away. And for all you single ladies out there, I always like to say this, I know, and so you could see how crazy these rules are. If you get married today and your spouse passes away tomorrow by accident, meaning they accidentally got hit by a bus and you could prove that it wasn't you who pushed them, then you could get benefits immediately. Right, so that you could see there some of these crazy rules, but in all, joking aside, the whole point of this is that you're now eligible for 100% of whatever your spouse was collecting at death. So now it matters when they file, because before it didn't matter. You were still eligible for 50% of that benefit. Now you're eligible for 100 of whatever they were collecting. So if Jordan had filed early, in this situation, he would have been collecting $1,833. He passes away. Alex gets $1,833. If he had waited until 70 to collect, he would have been collecting $2,904. He passes away. What does she get? $2,904. So over $1,000 difference simply because she decided to wait to collect benefit. He decided to wait to collect benefits at a later time, right? So this is important also because remember, right now, over half of those currently collecting Social Security benefits are widows collecting directly based off of their husband's record. So how you gentlemen file can directly impact what your wives will receive for the rest of their lives. So you want to make sure you're making the best decision possible. Now that we've gone over some of the basics, I do want to go over some of those strategies I promised you and how to maximize your benefits. I'm going to go through this a little bit quickly so we can leave time for questions if you have them. But in terms of the strategies, let's assume worst case scenario, you need to file at age 62 for the income, right? Your longevity is not that long. In this case, they're only living to 75 and 84, right? Jordan and Alex file as soon as possible. Jordan passes away. She now files for her survivor benefit. They receive over $600,000. Let's assume now they wait till their full retirement age to collect. Now Jordan's collecting his full $2,200. Alex is collecting her full $1,100. He passes. She files for his survivor benefit of $2,200. And altogether, they receive over $633,000. Let's now assume worst case scenario. They wait till 70. Right now, Jordan's getting a $2,904 because he got the full delayed retirement credits. And then Alex still collecting those $1,100 because remember, her benefit never increases. And Jordan passes away. She files for his $2,904, and altogether they receive over $600,000 throughout their lifetime. If you look there at the bottom of the screen, it happens to be that the worst case scenario is waiting till the last second, right? So waiting to the last moment to file doesn't necessarily mean it's the best case scenario, right? If this particular couple had employed a strategy, they could have really maximized those benefits. So let's assume, right, that the individual Alex filed at 62. She files as early as possible. Alex files as late as possible. That typically yields the best result, right? They're receiving over $634,000 throughout their lifetime. Normally, when you have a very high earner and a very low earner, when the higher earner takes it as late as possible and the lower earner takes it as soon as possible, that normally yields the best result. Not in all cases, but in most. Now, if you notice in the next slide, not much changes, right? Other than they're living much longer. They're living to 85 and 92. So now longevity is no longer an issue. They employ the same strategy. Now they're making over $1 million throughout their lifetime. So you really can receive a lot from Social Security if you employ the right strategies for your particular situation. Now, excuse me, if you recall, I told you there was 2 strategies that were eliminated in 2015. One of them was grandfathered in. This is it, right? So if you were born on January 1st, 1954 or earlier, you are lucky enough to have the ability to pick and choose which benefit you'd like to take, right? So up until now, I told you didn't have a choice, right? You can either choose your own or half of your spouse's, whichever is higher. Well, if you're born before 1954, you have the ability to say, you know what? I'm just going to collect on my spouse and I'm not going to touch my own, right? So here Alex files so that Jordan has access to that money because remember, that's always a rule. Alex has to be collecting for Jordan to have access to half of her benefit. He collects $1,000 off of her, right? Because her benefit's typically $2,000, so half of that. And he collects that for up to 4 years. At 70, he then files for his highest benefit available. He's now collecting $2,904. Altogether, they receive almost $1.4 million throughout their lifetime. Right, so this is a way for literally one spouse to possibly collect early, the other spouse to collect up to 4 years of free money, literally, because what's happening to their own? Their own is increasing every year, right, up until the age of 70. He's not collecting his, he's collecting on hers, right? So he's collecting that free money, and then he could collect up until the age of 70 or somewhere in between. And altogether, they could really maximize those benefits. So everyone who was eligible for this turned 66 last year. So if you do find yourself in this situation, please reach out to the team and have them run an analysis because at this point, you could be missing out on money that you are eligible for. And if this isn't you, let your friends and family know. Believe it or not many individuals are aware of this particular strategy. And it really is a great strategy as you realize they figured it out and hence why they got rid of it, right? So those who are grandfathered in, I do urge you to reach out to the team and see if this works for you and or your spouse. Now, if you do find yourself in the unfortunate circumstance that your spouse passes away, you do have ability to maximize these benefits as well, right? So in this situation, you can actually collect survivor benefits as early as age 60, not 62. And you can actually collect them as early as age 50 if you were disabled previous to your spouse passing away. So in this situation, even though, Chris goes ahead and files for survivor benefits early and they are reduced, he's not touching his own. So his own at 70, he turns his back on. he's now collecting his highest benefit available, and he's collecting over $1 million throughout his lifetime. Works the other way around too. Let's say, for example, your survivor benefit will always be more than your own. You can file for your own first, your survivor benefit later. And again, that would help maximize your benefits. The whole point of this, everyone, is to understand that if you do find yourself in this situation, it's a tough one, right? So you want to make sure you're leaning on your financial advisors here to help you make the decision as to which one of those benefits you want to file for first. So everybody's favorite part of the presentation, divorce, right? Because let's be honest, if you haven't been divorced yourself, you know somebody who has, right? So if you've been waiting for me to get to this part, this is your moment to shine, because this is probably where Social Security gets super fun in the sense of all the rules get a little crazy, right? Because as a spouse or a divorced spouse, you're eligible for benefits off of your ex as if you were married to them. As long as you've been married to them for at least 10 years, you remain unmarried, and both of you are at least age 62 when you file. That is literally the only requirements, right? Other than possibly being divorced for at least 2 years, and you're eligible for 50% of your benefit, of their benefit while they're alive, and 100% when they pass away. So this, you do have to put in 10 years, right? I always like to say, if you do the crime, right? They like to say you do the crime, you do the time, in the sense, if you do the time, you actually get the benefit, right? Before, you only had to be married for a year. Now you do have to be married for a solid 10. So if you are teetering on that mark of getting divorced and you're rounding that 10 years, you may want to stick it out a little bit longer, right? Because it is a solid 10-year rule. But again, all you have to do is go down to Social Security with your marriage certificate and your divorce decree, and they're going to tell you what you're going to be eligible for. Because there's no divorce decree in the world that can stop you from receiving these benefits. As a matter of fact, your ex-spouse's benefit never decreases because you're collecting on their record. Matter of fact, they never actually need to know, right? They don't get notified that you filed on their behalf. The only way that they ever find out that you filed on their record is if you decide to send them a nice little note saying, ha ha ha, still collecting off of you. If you didn't do that, trust me, they'll never find out, right? Because their benefit doesn't decrease or get affected by you in any way, shape, or form. Just to kind of give you an idea of how this works, if you all remember Johnny Carson, he was married 4 different times. 3 out of the 4 wives were all receiving benefits at the same exact time for the same exact amount. Right? So you can kind of see where Social Security went a little bit wrong when it comes to divorce benefits. But if you meet the requirements, you are eligible for them. Now, of course, if you remarry, you don't meet the requirement anymore, so you do lose out on those ex-spousal benefits. But if you get divorced again after 10 years, because remember, single life may be for you, now you could do a little bit of shopping, right? Because you've been married to both those spouses for at least 10 years. You go down to Social Security with 2 marriage certificates, 2 divorce decrees, and you say, hey, which one of these spouses is going to pay me the most, right? They're going to give you the highest benefit available. Now, if your ex-spouse passes away, you're now eligible for 100% of whatever they were collecting at death, right? Just as if you were married to them, you only have to have been married to them again for 10 years. You have to be at least age 60 years old. And if you do remarry, you can remarry and keep those benefits as long as you remarry after the age of 60. So this is the only time that you can remarry and keep them, is if you remarry over the age of 60. If you remarry under that, you do lose out on those benefits. But if you don't, and you get married above 60, then you could keep your own, right? You could choose between your spouse's, your new spouse after 1 year, or your deceased ex-spouse, right? So you have a lot of choices. Again, reach out to the team, let them know. I'll tell you, I've been doing this for over 15 years. There's not a seminar that I ever give that somebody just says, I had no idea that I was eligible for this, or I'm sure my friends had no idea. So please share this information if it doesn't help you, because believe it or not, a lot of individuals are not aware, and have them come see the team so that they could run an analysis on those particular benefits, because a lot of individuals do miss out on receiving those ex-spouse's benefit. Now, of course, no good presentation could ever end without talking about taxes, right? If you're sitting there going, wait a minute, but I've been paying them on my way in my whole life. You're telling me I'm going to be paying them on the way out too? Yep, sadly, most of you on this call will. And the only reason I say that is because the threshold's not that high, right? So the way that they look at it to determine whether you're going to be taxable on your Social Security benefits is that they look at your provisional income, which is derived of half of your Social Security benefits plus your modified adjusted gross income, and they apply it to this lovely chart. So if you're married filing jointly, none of your benefits will be taxed. Good news, right? If you're making between $32,000 and $44,000, married filing jointly, up to 50% of your benefits could be taxed. And if you're making over 44, then up to 85% of your benefits could be taxed at your marginal tax rate. So it's not 85% tax. Again, it's 85% of your benefit could be taxed at your marginal tax rate. So this is, again, one of those situations where you're going to want to not only work with your financial advisor here, but also your CPA, so you can help determine where you're going to fall within this tax bracket. And you can make that determination of whether you want to file for Social Security benefits or not, because how you're going to be taxed can make a big impact of whether you do want to collect if maybe, let's say, you're in a very high tax bracket. So I told you before, if you file for benefits early, they're reduced. If you file for benefits early and continue working, they could possibly be withheld. Right now you've reached Medicare age and your Medicare premiums start to come out. And then on top of it, you're possibly taxed. If you're getting my drift, the whole point is that, right, your benefit that you had originally anticipated could be very different than what you had expected, right? So you want to make sure that Social Security is an important decision, but it also shouldn't be your only one, right? It should be a very small part of your retirement plan. Social Security mostly pays out to a couple around $22,000 a year. As Elliot mentioned before, I do live on the Jersey Shore. I do love it here, but it is very expensive. I say that $22,000 probably mows my lawn for the year, right? So you want to make sure that you are getting through your retirement comfortably and thinking about all the other things in the goals you need to reach in your retirement in order to make that more comfortable. And that Social Security shouldn't be your only decision, right? But when it is that you're ready to make that decision, understand that all you have to do is print out your statement, make an appointment with your financial advisors here. It's completely free. Have them run an analysis. And remember, I can tell you a million different ways to file, right? There's a million different ways to do this. But at the end of the day, none of that really makes any sense if you're not talking to your financial advisor as to how to incorporate that into your overall financial plan, right? Because if I tell you, hey, your best bet is to wait till 70 to collect, but you're going to, deplete your entire retirement income to get there, then at that point, that doesn't make any sense anymore, right? Then you wouldn't, filing at age 70 wouldn't be the best case scenario. Right? And then when you are ready, remember, you could file online, in person, or on the phone. I do suggest online. It is my preferred method. It is Social Security's preferred method. I never recommend any of you ever go into a Social Security office, actually, if you never need to. Right now, the in-person option is not available considering COVID. But if it is available shortly, remember to make an appointment, so you're likely to get somebody that is going to be able to help you file your application, or you could do it on the phone. So with that, I know I gave you a lot of information in a very short period of time. Sadly, I could tell you I just reached the tip of the iceberg on this. I could go on for hours. It takes around 8 years for a Social Security representative to learn this, so I definitely didn't expect you to be expert in 50, but hopefully the whole thing was just to help you feel a little bit more comfortable so that you understand what questions you need to be asking, and some choices that you do have, and understand that this is a big decision, and to please incorporate your financial advisor in that decision so you're making the best strategy for you and your spouse. So with that, I'm going to go ahead and turn it back over to Elliot to see if you have any questions.
Jennifer, that was great. We do have a question for you, and thank you for doing that. I won't even discuss your marital advice or your divorce advice.
I am married, thankfully, still. So.
No, I was married for 18 years, and I've been divorced for 18 years. And so I'm just listening to it's one of the things that we hate about in divorce conversation is that 10-year number, because we feel like something magical in a negative way really happens, that, okay, I don't really like you after 5, but I'll stay in it until 10, just so I can be considered to have a long-term marriage and get your Social Security number. So everything we don't like about the stereotype seems to happen at the 10-year number.
It does. I always think that everybody should reevaluate after 10, but don't tell that to my husband.
How long are you married?
4, I think.
All right, well,
yeah, 4.
Six to go.
It feels like 20. No, I'm kidding.
So anyway, one of the questions, I know you answered the question about that had been going on for the old way, where I could file at 66, 67 and suspend it. And you answered that's been replaced with, if I'm eligible, then my spouse can collect half.
Correct.
Right. So here's my question, because I get asked this a lot. Obviously, if I wait every year, the 3 years from 67, 66 to 70, my account will go up by 8% per year, correct?
Correct.
And it will go down, if I do it at 62, it will basically go down by 8% per year as well, correct?
No, not necessarily. So the calculation depends on your full retirement age. But let's say, for example, you have full retirement age of 66. The reduction at 62 is 25%.
Okay.
And then as you get closer, it's less.
So it's not that bad. It's not going
No.
down as bad. Okay. So the question is, and I call this not an income bet, but let's talk about a longevity bet for a moment.
Mhm.
I mean, obviously, you're going to make more money if you wait till 70 and you live till 90 versus waiting till 62, starting at 62 and live till 90.
Mhm.
But there is a bet people make on themselves, and they look at their parents and they say, well, my parents died at 70, so I should take it at 62. And we're not our parents. We live longer. We tend to live healthier. That's not always true. There's a bit of luck and genetics involved here, but there's definitely luck because it happens. Unfortunately, good things happen and bad things happen, both on the luck side. So I tell people that if you took it at 62 and you waited till 70 and you lived past 72, you did great. But if you took it at 67 and you lived to 77, you made the right choice. Is that 10-year number a fair number?
I always say no, only because the break evens really depend on your benefit amounts and how long your longevity is in comparison to also your spouse. So there's a lot of moving parts. I don't feel like it's just as easy as, 10 years. And the cool thing is that we're able to run the analysis assuming all those particular factors and get you a break even dependent on all that information so that you could say, okay, I don't think I'm going to live past that age, then I should file earlier. And it kind of helps you make that decision a little bit easier. But I don't think it's as cut and dry as a certain amount of years. But for the most part, you don't want to file early if you're going to have long longevity, because then you're doing yourself a disservice, right? Because the longer you live, the more you make if you maximized your benefits. So I think sometimes what you don't realize is that you file for benefits early and it actually turns out that, you live longer, that was not the better situation. So, I mean, yes, we're always taking a bet. Let's be honest, none of us know. So you are, but if you're incorporating that spouse into it, you have to remember that your spouse makes is a big part of that, right? So maybe you filing at 62, you're also stopping your spouse from receiving a higher amount should you pass away. So it really is like, a collective decision that you need to be making together.
Great. Well, you've been great. I want to thank you, Jennifer. I want to thank you, Samantha, for bringing Jennifer to us, the folks at BlackRock, the largest investment company in the world. So thank you very much. You've been listening to Meet the Expert. I want to tell you that next Tuesday, we're going to do this again, but at 11 in the morning Pacific time. We're going to go back to 11. We're still trying to get our right time. We do record these. We do put them on our website in a few days. So if you missed anything and you want to hear Jennifer 2, 3, 4 times, you want to bring a copy of it to your marital counseling conversation, at $150 an hour and have them listen, you could do that too, since she gave such strong advice on the marital world. We'll talk offline about that. But next week, next 11 a.m., Rob Scott is going to be talking about the mortgage market with the rates, what's going on. I mean, there's a drive to the bottom in the mortgage market. We're seeing them below 3 now. In 15-year terms. So we're going to talk about that. And we're going to talk about why people make certain financial decisions that they do, because the average American makes the wrong decision at the wrong time. And what can you do to not be that person? So we're going to talk about that. And we're going to have a behavioral finance psychologist on to talk about it. So we're excited about that. Anyway, if you need to reach me, you want to send a question post this event, I'm at Elliot, ELLIOT, at prosperityfg.com. 925-314-8503 is my direct line. We've got Emmett, we've got Jamie, we've got lots of people here that can answer your questions. So on behalf of your team at Prosperity Financial Group, I want to say thank you for joining us today. To those dads out there, have a terrific Father's Day on Sunday. My dad has gone 32 years, so Dad in heaven, I hope you're looking down and smiling and thinking we're doing a great job. So God bless everybody and have a great day.